Now that interest rates have been getting cut, a number of high-yielding investments that were pretty unattractive for a couple of years have now started receiving a lot more interest. After more than 2 years, an entire sector that's now become more appealing to high-income investors is mortgage REITs. And as I've been discussing on this channel for a while, it is true that when interest rates are falling, then these kinds of investments typically perform much better. And one of those investments specifically that's received a lot more attention and more buy ratings from analysts is AGNC Investment Corporation. This 15% yielding monthly dividend-paying stock has been getting a lot of buy ratings by Wall Street analysts over the past couple of months. They've also updated their website recently, which highlights their stock's pretty good return since their IPO. AGNC has also grown to become the second largest mREIT in the sector, right behind Annaly Capital. So with an improving environment, is AGNC a more attractive holding today? In this video, we'll take an in-depth look at this company and see how it's been doing and where it might be headed. According to their website, it says, AGNC invests in America's greatest asset. We are an internally managed mortgage REIT built with the objective of generating favorable long-term stockholder returns with a substantial yield component through levered investments in agency residential mortgage-backed securities. So if you're not too familiar, most mREITs, including AGNC, are companies that hold mortgage-backed securities. They raise money through debt or issuing new stock and buy these securities from financial institutions. MBSs are pools of mortgages that are bundled together and made into securities that companies like AGNC buy. They then collect the cash flow from these mortgages and pass them on to shareholders in the form of dividends. You've likely heard of these investments if you were investing back in 2008 during the financial crisis, or if you've ever seen the movie The Big Short, in which MBSs received a lot of the blame for the global meltdown. Today, a lot of people are still turned off by these mortgage-backed securities, but it's important to know that borrowing standards are much higher today than before the crisis. Legislation was passed that created stricter borrowing standards to avoid another mortgage meltdown. So these investments are a lot safer today compared to 20 years ago. What's more is that there's two kinds of MBSs that exist, which are known as agency and non-agency MBSs. Agency MBSs are mortgages that are backed by government-sponsored enterprises and greatly eliminate credit risk. To give a very basic example, the process looks like this. An individual will go to a bank looking for a mortgage, which will perform due diligence to determine if they think that this person will be able to comfortably pay back their mortgage on time. If they issue them a mortgage and it meets certain requirements, then the bank might decide to transfer the mortgage to a government agency, which bundles them into guaranteed securities known as agency MBSs. Fannie Mae, Freddie Mac, and Ginnie Mae guarantee millions of conforming mortgages that are originated by U.S. lenders each year, which protects investors in the event that homeowners default on these loans. Then finally, companies like AGNC will buy them, which include an agency-backed guarantee against default. So this premise convinces a lot of people, and it sounds like a great investment, doesn't it? Roughly 98% of what AGNC holds are these agency MBSs. If you have a company that holds investments that are fully backed by the US government and have no default risk, how on earth could you lose money from something like that? Well, as it turns out, there's a lot more going on with these mREITs. For one thing, these agency investments that AGNC buys don't typically come with very high yields. Anytime you have an investment that's considered extremely safe, it's not likely to offer that attractive of a return, usually. So how do mortgage REITs offer such high yields, typically upwards of 8%, 10%, and even 15% in this case? The answer is they have to use a lot of leverage. Using leverage, and a lot of it, is always very risky because it can magnify gains, but also magnify losses, and mREITs like AGNC often use a lot of it. These securities also become less attractive to investors when rates are higher. Also in high interest rate environments, mREITs' earnings will fall. This is because they have to borrow money to buy these securities, which they pay interest on. In the past, we've seen plenty of mREITs do horribly when it comes to using leverage. If we look at AGNC's performance this year, it's actually done pretty decently. A 1.04% share price increase might not sound too good, but remember, it offers a 15% dividend yield. If you reinvest those dividends, then you'd be looking at a year-to-date return of over 15%. Pretty good compared to a typical year in the S&P 500. Let's look at their latest financial results, which came out on October 21st. This company refers to the money they have available for dividends to shareholders as net spread and dollar roll income per share. This is different compared to other mREITs that I've seen, but there's also no unified way of reporting this metric for all mREITs. There is no set guideline that says all mREITs must report this metric in this exact same way, because they can pursue different investing strategies. In the case for AGNC, in addition to their MBSs, they generate a lot of their income from interest rate swaps. So when you see 63 cents in comprehensive income per share, this is not the metric you want to use to calculate their dividend payout ratio. You want to use the net spread and dollar roll income per share. This gives AGNC a current payout ratio of 83.7%. Now that is comfortable from an REIT perspective, but you need to know that it's been going down every quarter for the past 2 years. Their most recent quarter saw a greater than average fall in income, which appears to be a one-off situation regarding something in their portfolio. They talked about how they were anticipating this in their latest earnings call, so it wasn't really a surprise to them. But their current dividend, which is 12 cents a month or 36 cents a quarter, is coming very close to being greater than this number. But now, what about interest rates falling? This is expected to benefit this company and their earnings, and hopefully will stop this number from free falling, potentially even growing if rates do get reduced enough. It would also benefit some of these other numbers that you're seeing. You can see their cost of funds has gotten really high because of high interest rates. This will go down as rates go down, leading to potentially better profits. Their average asset yield has gone up, but this will go down when rates get cut, at least on their newer holdings they acquire. But considering rates just recently started getting cut, it's still a little too early to see any kind of changes in this company's performance. I also want to go back and look at this total return that they tout on their homepage, because although it does look really impressive and no doubt has convinced some people to buy AGNC, this is a bit misleading. The majority of the returns from AGNC have been from their dividends. In order to have received this 435% total return from their stock, you would have needed to reinvest all of your dividends. It says that right here on their website. But the people who hold stocks like this are typically those who want to live off the dividends and not reinvest them. If you did not reinvest your distributions, your total return would have been much lower. Looking at their dividend distribution history, you can see they've gone through several cuts in the last 10 years. If it was your goal to live off of AGNC's dividends, you would only be making about half the income today that you were a decade ago. So all of a sudden, this 435% total return doesn't sound so great, does it? Their book value, another really important metric for these investments, has stabilized over the past 2 years. However, just like most REITs, their book value has gone down sizably over the years. Book value per share is the metric that most people value these companies at, so as of the making of this video, AGNC is just slightly considered overvalued, or I even think referring to it as fair valued would be reasonable. So with all things considered, what are we to make of AGNC? In the short term, I think this stock could do much better. They will likely see improving numbers as long as we gradually see interest rates get cut. But keep in mind the long-term performance of this company's stock. Just like Annaly Capital, Armor Residential, and many other REITs, they've seen consistent share price declines over time. We will likely see better performance from all these companies in the short term, but what about 5 or 10 years from now? These REITs were still reporting losses and cutting their dividends when rates were near zero. So if you're looking for something to hold in just the short term, then AGNC is a more appealing investment. But really think hard before considering them as a holding that you would want to depend on to pay for your living expenses. Keep in mind, this company hasn't been able to grow their dividends since 2009, with the exception of them switching to monthly dividends. It's hard for me to place a lot of faith in a company with a track record like this. Now, if you want to dedicate a small amount of your portfolio to AGNC for speculation or try to earn some short-term gains, then it is a worthy consideration of that. But I would be very cautious against putting a substantial amount of your portfolio into AGNC if you do intend to live off the dividends. But with that being said, that's going to conclude today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.